Class number 10, the budget process and variance analysis. Every organization must have a plan. To ensure that a plan is taken seriously, the stakeholders must hold themselves accountable along the way. In this class, we will discuss some concepts that will test your goals for accountability.
A budget is an organizational plan stated in monetary terms. It is a detailed list of the anticipated income and expense of the credit union. In many ways, it also serves as authorization for the credit union CEO to implement that budget. Traditionally, budgets are prepared on an annual basis. The purpose of a budget is twofold. Number one, it allows you to forecast the income and expense of the credit union. Number two, it allows you to compare budget to actual results to monitor the performance of the credit union throughout the fiscal year. A variance is a comparison between the actual results realized and the budgeted performance outlined in your business plan. It is often used to evaluate the effectiveness of management and the results of the credit union.
The amount of the variance goes a long way in telling the credit union how well you're doing in planning. But you should also remember that variance may be necessary as goals change during the fiscal year.
A budget is a planning tool. It's based on what was known well in advance of a particular event or circumstance. It should be used as exactly that. It is a roadmap, it is a guideline. It is not cast in stone.
Budgets may need to change as goals change. Budgets should be revised as the credit union revises their goals during the fiscal year.
It's very common to use actual performance realized over the past fiscal year as the basis of the creation of the next budget. That alone would make the budget very stale. You need to use current forecasts on interest rates and other economic factors to make the budget more accurate. The variance analysis looks to the difference between the actual performance realized by the credit union to the budgeted amounts on your income statement. It's also a tool that the board of directors can use to zero in on items that may be cause for concern and certainly areas to explore further. As a board member reviews their variances, it's much more important to drill down on variances with material differences than it is to examine every single line item. This allows the credit union director to be informed on things that are going counter to plan rather than looking at things that are acting in accordance with your plan. Credit unions have long used the ROA, or return on assets, as a key indicator of how effectively they're earning on their assets. Historically, credit unions thought a 1% ROA was a great goal. In these economic environments, anything above a 0.5% ROA is actually a very good goal.
A budget is an organizational plan stated in monetary terms. Completed on an annual basis, a budget gives the CEO the authority to spend money on behalf of the credit union. Budgets list all planned expenses as well as revenues. The purpose of budgeting is to forecast income and expenses and to serve as a tool to measure the performance of the credit union. A variance is the difference between the actual amount earned or spent and the budgetary amount. Budgets are never set in stone and should be revisited or recast throughout the year. When creating a budget, the use of historical financial statements are the best resource for getting started. However, if the standard budget is established by using only historical information, the budget will quickly become outdated. Variance analysis is a budgetary tool to evaluate performance between the budgeted planned amount and the actual amount incurred or earned. It is designed to foster questions at the board level about the performance of the credit union. It is more important for the board of directors to review line items with significant variance from expected or budgeted amounts than to review every line item on the income and expense statement. A ROA ratio of 0.5 would be considered healthy. Time to take the test. Good luck.